Well, Target is cutting 1,800 corporate jobs as the retailer aims to return to growth after 4 years of stagnant sales. The company's shares have dropped by more than 60% since reaching an all-time high in late 2021, significantly underperforming compared to competitors. However, my next guest still maintains a buy rating on the stock. Let's welcome Michael Baker, Managing Director and Senior Research Analyst at D.A. Davidson. Michael, thanks for joining us.
Sure, happy to be here, Roger.
What do you like about the stock in general?
Well, part of it is valuation, for sure, and the stock has come under a lot of pressure, but we think there's a lot of bad news priced in, and at 10, maybe 11 times forward earnings, it is one of the cheaper names in our space. So we think it can make some money in a stock when things go from very bad to just bad. And we think trends if they haven't bottomed yet, they're pretty close to bottoming, and that's where we see some upside in the valuation if things just start to get a little bit better.
Okay, let's talk about the layoffs. HQ layoffs, how do you read into that?
Yeah, we think this is maybe an example of an early sign of things maybe getting a little bit better. We think it's sort of a strong, decisive move from the incoming CEO. He starts in February. We estimate there's probably about 9,000 corporate jobs in total. So this is they're taking 1,000 jobs out plus not hiring another 1,800. So in total, that's about 10 to 20%, depending on how you want to look at it, of the corporate headcount. That's a big move. We think not only, by the way, will it help save costs, but it will make the company more efficient in the sense of quicker decision making, fewer layers. We just think they got really bloated over the last few years. And so this should help with that kind of efficiency and decision making, and again, a good early first step in the turnaround.
Yeah, what happened? I mean, there hadn't been a layoff in 10 years.
Yeah, well, we can go back to 2021 as an example. Since that time, their sales are flat. And again, our estimate of their corporate headcount relative to their total company headcount is up 23% over that time versus flat sales. To me, that's bloat. They did really, really well during the pandemic. I think they added a lot of people during that time, and they've just been slow to cut back on it.
And the new CEO is coming in from the inside. Any concerns about that?
Well, certainly the market would have wanted somebody from the outside, just under the idea of new blood, new ideas. And one of the pushbacks against Michael Fidelki was, well, you were the CFO and the chief operating officer while things weren't going that well. What can you do differently? But I think we're seeing an early sign of what the answer to that could be. Again, he's not even the CEO yet. He's the chief operating officer, but making what we think is a pretty bold and decisive call here.
What would you like to see? What else would you like to see him do?
To me, Target's all about merchandising. They are in a tough spot competing with the likes of Walmart, Costco, Amazon, three obviously very strong competitors. So Target needs to give customers a reason to go back into the store. What made Target great in the past was merchandising, making it a fun place to shop, showing customers things that they wouldn't otherwise see elsewhere. And I think they need to get back to that. There was a little bit of a green shoot in that sense in the second quarter where their hard goods area was up 6% on the strength of things like Taylor Swift product, trading cards, those types of fads that in the past Target has been very good about finding and leading into. And so we think they need to get back to doing a little bit more of that. And
stay away from, should they try and chase food and things like that or no?
Food is part of their business, but it's small relative to some of the other names I mentioned. It's about 25% of their business. That's been okay for them. One of the issues, though, we think the bigger issue has been some of the weakness in more of the home goods or hardline type areas. And that's really where we think the turnaround is going to happen.
And you still have it as a buy rating? Still holding strong on that?
We do. It's not been our best call. The stock has been down. But we're looking forward, not backwards. And from here, we do think there's real value. Again, if anything starts to go right, we think the multiple can expand and it could end up being a good name to own. We've done some analysis that we think the stock could be worth $108 if they were to simply get margins back to where they were in 2023. That's 18 months ago. That's not that long ago. If they can go from about 4.5, which is where they're running today, to 5.5 over the next 5 years, we think you can earn a 20% annual return on the stock over the next 5 years.
Okay, and we'll leave it at that. Michael, thank you very much for joining us.
Sure, thank you.
Michael Baker is the Managing Director and Senior Research Analyst at D.A. Davidson.